Understanding key ratios, a comprehensive overview. In the world of finance and investing, understanding a company's financial health is crucial for making informed decisions. One of the most effective ways to gauge this health is through the use of key ratios. These financial metrics summarize and illustrate a company's financial condition, offering insights that can guide investors, analysts, and stakeholders in their evaluations. What is a key ratio? Key ratios are essential financial ratios that provide a snapshot of various operational aspects of a company, enabling stakeholders to compare its performance against competitors and industry benchmarks. Core characteristics of key ratios. Financial snapshot. They summarize essential financial data derived from a company's financial statements, making complex financial information more digestible. Comparative analysis. Key ratios facilitate comparisons between companies within the same industry, revealing strengths and weaknesses relative to peers. Focus on specific areas. Different key ratios provide insights into various facets of a company's operations, including liquidity, profitability, efficiency, and leverage. How key ratios work. Key ratios utilize data from multiple financial statements, typically the balance sheet, income statement, and cash flow statement. By comparing certain figures from these statements, financial analysts can create ratios that reflect critical aspects of a company's performance. For instance, liquidity ratios, such as the current ratio and quick ratio, highlight a company's ability to meet its short-term obligations. Profitability ratios, metrics like return on assets, ROA, and net profit margin show how effectively a company generates profit from its resources. Leverage ratios, ratios like debt to equity, assess the degree to which a company uses debt to finance its operations. Commonly used key ratios. While there are countless financial ratios available, here are some frequently used key ratios. 1. Return on equity, ROE, measures profit generated per dollar of shareholder equity. 2. Earnings before interest and taxes, EBIT, margin, indicates company profitability before financing costs and taxes. 3. Price to earnings, P/E, ratio, compares a company's current share price to its earnings per share, giving insights into valuation. 4. Current ratio, evaluates a company's ability to pay short-term liabilities with its short-term assets. 5. Debt to equity ratio, provides insight into the company's financial leverage by comparing its total liabilities to shareholders' equity. Industry variance in key ratios. It's important to note that key ratios vary by industry. For instance, banking sector, key ratios often include the capital to assets ratio and liquidity ratio due to regulatory requirements and the necessity for managing deposits and loans efficiently. Technology sector, commonly analyzed ratios may include price to sales, PS, and return on research capital, ROC, reflecting differing operational dynamics and investment methodologies. Example of a key ratio analysis. Consider a scenario where an analyst named Sam from XYZ Research is assessing the financial efficiency of ABC Corporation. He downloads the company's recent financial statements and examines various figures such as net income, total sales, and operating expenses. By calculating profitability ratios like ROA and the profit margin, he gains insights into how well ABC Corp manages its expenses to generate profits. Advantages and disadvantages of key ratios. Advantages. Holistic analysis. Key ratios allow for a comprehensive assessment of a company's financial health by examining different operational aspects. Peer comparison. By analyzing these ratios, investors can identify companies that outperform others in the same sector. Easy interpretation. Ratios simplify complex financial data into manageable insights. Disadvantages. Single metric limitation. Relying on one or two ratios does not provide the full financial picture of a company. Effective evaluation requires a combination of ratios. Accounting variations. differing accounting practices among companies can complicate comparisons and evaluations. Market conditions, economic trends and market fluctuations can influence ratios, requiring context-based interpretation. Conclusion. Key ratios serve as powerful tools for gauging a company's financial health and performance. Understanding these ratios, along with their advantages and limitations, equips investors and stakeholders with the knowledge needed to conduct thorough financial analyses. However, it's vital to remember that no single ratio can encapsulate a company's entire situation. A multifaceted approach using a variety of key ratios provides the most accurate insight into a company's operational efficacy and financial stability.